Testing. Test, check. Okay, hopefully you can hear the stream now. Let me know if there is any sound coming through. Yes. Just gonna go ahead and wait a minute for hopefully other people to find the stream. Good. Glad to hear. I don't know what the problem was before. It's just the mystery of YouTube. It might be a smaller stream now, but that's okay. We'll have an intimate conversation between the three of us. Nice to see you, Sam. Mr. Smith. I presume you're a Mr. Smith. Where are you two coming in from today? Let me know. Technical difficulties, as always, but there's always a solution, unfortunately. Sometimes it involves having to restart things over again, but that's okay too. So Sheffield and Manchester, two places I'm very familiar with. Hopefully the sun is shining up in Manchester. I'm just going to do a couple of things while I'm waiting for other people to come on the stream. My very closest school friend who now lives in Sheffield, who I went to school with down in Dorset, is from Sheffield. Actually, he lives in Manchester now, but he always used to say Gior. When I first met him, I didn't understand what Gior was, but good. Glad everything is working now. So yes, hi. I'm still over here in rainy Florida at the moment. Unsure of when things are going to be okay to travel, but hopefully soon enough. I'm glad everybody is here on this stream. I have a lot to get to tonight. Or what are we going to be talking about? We're going to talk about Ratesetter, what's going on with them, and the top 5 list. And we're going to talk about Assetz Capital. We've had some rate target reductions from Assetz this week. Loanpd, Kuflink, Crowdproperty, Property Partner, a little bit of Lendy, and some talk about some negative interest rates, what's going on with that. Some interesting things have happened with negative interest rate bond offering, which is very strange, but I mean, obviously not strange, but we'll look a little bit about that. So just see who's on the stream. We've got Mr. Smith, Sam in Sheffield, Colin, still in the Peak District as always, Aki Chap in Accrington, Derek Thorpe in the chilly North Devon, raining steadily. I'm glad. I always like the weather updates. So we have David Kennedy in Norfolk. Hi, Peter in Leatherhead. Yeah, we have seemed to have lost a lot of people, but if they go back to my YouTube channel, they'll see the new stream link. So unfortunately, not everybody knows how to get to streams, but I think they'll find it if they're logged into YouTube. So they'll get a little notification. Yeah, Sam, I'll give you an update on Property Partner. What's going on with them today? Yeah, hit that thumbs up button if you can. Appreciate it. Hi, Mike in Southampton. Fellow member of our Facebook group. If you haven't joined the Facebook group, I highly suggest doing it. It's really a party. We have a party on the Facebook group every day. So send me a message and I'll invite you into the group. It is an invite only, just for you special VIPs. Hailing today in York. Hail, really? Wow. Hail in June. Yes. 2 weeks quarantine when I arrive in the UK. Oh, gosh. That just doesn't sound like fun, but that's okay too. Anyway, enough of that. Welcome to everybody. I think we're all familiar faces on the stream. For anybody new, welcome. We're going to go through the news. Call it the peer-to-peer news hour. And if you have any questions or comments, put them in the chat. We'll address them. And let's start out with my top 5. It hasn't really changed much. I did add a couple of actually one new investment this week through Crowdproperty. It's been on my radar for a while. I just haven't taken the time to go ahead and open the account, put some money. So I did that this week, and I've recorded a video walkthrough tutorial on Crowdproperty and how their investment works, how the dashboard system works. And I've been pretty impressed, been really happy. I'm using the auto invest mainly because I don't feel like fighting with the other people to try to get a piece of the pie on manual loans, whereas auto invest, it gives you an allocation first before the manual investors. But they have put a cap on the manual investing, but I just prefer the hands off the auto invest. I think all of their deals are very solid. So I've added them, not to my top 5 because I haven't been investing with them long enough, but I did invest through Crowdproperty, and they were on my sort of top 2 list of companies that I wanted to use that I haven't yet. So my top 5 is still the same as last week: Loanpd, Lendy, Assetz Capital, Kuflink, and Octopus Choice. And now I have a top 4 of companies that I'm not currently using or I haven't invested through for long, which is Blend Network, Crowdproperty, PropLend, and Investment Fund, which are all real estate-based companies with asset-backed property loans. So I did Crowdproperty this week. Seriously considering Blend, and I had a chat with one of the investment fund representatives this week, and I was actually really impressed with them. It's not a name that's been on my radar at all. I don't think that I knew really anything about them, and they were very quiet in the forums. But I had a good chat with Investment Fund, and they seem to have a very solid business plan, business model. They've been lending since 2014. They've just been doing so very quietly. They're not a well-known company in the peer-to-peer lending circles. So Investment Fund is now on my radar. I like their deals. I like the expertise of the people behind the company, and the process that they use is very, very, very similar to Crowdproperty. I would put the 2 companies almost identical, just different background experiences with the people who are making the decisions behind the loans, and also the founders who have a lot of experience in trading and financial. So Investment and Fund is now sort of on my radar under my top 4 companies that I either haven't used or haven't used for very long. So they've kind of snuck in there. So let's go ahead and we'll run through the news very quickly, and I'll answer any questions that you have. I looked at Ratesetter's provision fund today, and I also looked at sales progress within people who are trying to exit. Well, let's talk about that, because I know some of you are probably sitting in a queue waiting to get your money out, which I am doing a sort of a partial exit in the Access account. I have, let's see, I am number 375,076th on the Access processing. I don't know if that's a list or the way that they reference it, but that's my reference number. And I think by estimating what I've read about other people who have listed where they were on the list, Assetz is about 374,100 right now. So I'm 375,076, which is put in on March the 13th. And I think they're processing about 374,100, which means I have about another little bit less than 1,000 positions ahead of me before I'd be able to access anything from the Assetz account. The 5-year, I'm position number 408733, and I would estimate that they are processing 382,800, so quite a long ways to go with being able to exit out of the 5-year fund with the Ratesetter situation. So you can sort of see, how far back I am and how long it's probably going to take to get that exit money. My plan with Ratesetter is I don't think the company's particularly in trouble. I think that they're just, going through a lot of things that other peer-to-peer companies are going through with the COVID problem. And, people do get cold feet when things like that happen, and they do want to exit partially. And I think a lot of people are just exiting partially. From what I've received from readers and that I've read on the forum, a lot of people are taking their money out of the Assetz account, but not necessarily the 5-year lending account. So that's where that stands. And also on the provision fund side of things, they have about a little bit less than $8 million in cash in the provision fund on the interest fund coverage, and $22 million expected inflow. So right now the coverage ratio is 73% of what they expect the losses would be in interest. And they expect the losses would be estimated about £41 million, and they have coverage of a little bit over £30 million. And they are saying that with the cut in interest rates, now that fund will be 100% covered once they get more of the inflow in. So I think that's good news for investors. And then on the capital coverage side of the provision fund, they're at 169% coverage with 30 million in cash and 39 million expected coming in. And they expect the future loss to be 41 million on that too. So I think those are pretty positive numbers with the provision fund. Also, if you're interested in tracking, there's a good thread on the peer-to-peer independent forum where people are tracking their exits, and they're putting their position numbers in there, and you can see where you would stand on the position list. I'm going to put that in here if you want to track it. I thought that was a pretty cool thread that somebody has started. You can add yourself to that tracking chart if you want and see where you stand on the list. That's updated pretty regularly. So Assetz Capital announced a reduction in targeted rates this week. That's going to be June. QAA quick access account looking at about a 0.35% reduction down to 3.75%. And then the 30-day and 90-day accounts looking at down 1/3% on targeted returns, down to 4% and 4.1% respectively on those. So, I think that's just, again, what you would expect, that rates for investors will be reduced at this time. So nothing really surprising there. You do have to factor in that doesn't include the 0.9% annual management fee that you're going to be charged right now. That's a temporary fee by Assetz Capital. Loanpd, they've lost a loan this week, which I believe was paid back. So we've got 21 loans there now, 1 defaulted loan, 2 extended loans, average loan size of $385,000. And one thing that, I get asked a lot, well, why am I so big on Loanpd? The features on my top 5, and I'm always speaking about why I like Loanpd. And I figured I'd just share with you, this is exactly why I like Loanpd. If we look at their 1 defaulted loan, because their loan to values are so low, Loanpd, we're talking about having an average loan to value on their entire portfolio now is about 26%. The 1 defaulted loan, I figured I'd do a little bit of digging and see what exactly it is. And I uploaded a picture of the property that Loanpd has a first position on there. If you want to take a look at it, you can see it's a nice property. It's a good sized house. And the estimated value on that house, although it's a little bit difficult to say at the moment with what's going on with COVID, but I'm thinking anywhere in the 450 to 500,000 plus range on that house, and Loanpad's exposure to that house is only 150,000. So I mean, if you're looking for a relatively low risk peer-to-peer lending investment, that's why Loanpad is such a good position. They position themselves so well because they have £150,000 exposure on a value property that's getting close to £500,000 with that ultra low loan to value. So just the downside risk is very low. So this is why I like Loanpad so much. They're taking that first position even before Assetz Capital, as they've got the rest of the exposure on that loan. So I think the loan was 495,000 total. So Loanpad only has 150,000 of that exposure in first position. So that loan is in default. And if it gets to the point where the loan needs to be sold at auction or whatnot, or sold on retail markets, then Loanpad is going to get paid back first. And there's just very, very relatively low risk on that. So that's the reason why I'm so big on Loanpad, because their loan to values are so low. And so yeah, that's my little Loanpad blurb for today. Also, just a quick note, on Saturday, I don't usually do this, but on Saturday, I'm going to do another live stream. Here's the link, and it's going to be on risk assessment. So that's really, I think, a big overlooked part of peer-to-peer lending, and what we really struggle with as lenders is, how to assess risk, not only of the peer-to-peer lending companies themselves, but also of the different individual loan deals that are offered. So I'm going to do a live stream on Saturday at 7:15 p.m. UK time, maybe 7:30. I think 7:30. And we'll chat about risk assessment, how to best do that. Okay, so moving on, Kuflink, we had a small update this week for the month of May. They had 5 loans repaid, £700,000 in capital and interest paid out to investors, which is great news. And they offered a really high number of new deals in May of 10. So obviously, Kuflink is still lending, still looking for deals and putting out a great deal flow. So that's good news. When you see numbers like 700,000 being paid in capital and interest out to investors during COVID, that's a very good idea. I talked about, Crowdproperty. Like I said, I'll be putting up a screen share of what the Crowdproperty platform looks like and when I deposited my money. So if you're interested in that, you can sort of get a good idea of how it works. And then I gave my thoughts and feelings about the pros and cons to investing through Crowdproperty and some of the things on the dashboard that I didn't like. So we're going to go ahead and talk about Property Partner. They sent out an update to their and just a quick disclaimer, I do invest money through Property Partner. I don't have a huge amount through them anymore. I'd sold off a lot of my shares before COVID happened, but I still have a decent amount in Property Partner. But they've suspended their dividends until the 30th of September. The reason they're doing that is each property, they have to have a provision of cash that is there for any like late rents or any problems, things like repairs. And they found that their properties, they don't have enough of a fund buffer. So they're suspending the dividend payments to add to that fund buffer, which is unfortunate. And what's happening is they're finding out a lot of rents are probably going to either be late, they're going to have some rent shortfall. One of the problems that they've had is through their student accommodation investment, because obviously students are not on the campuses going to university at the moment. So they've had to release a lot of those contracts for certain terms that students had within the properties that they were living in, the Property Partner owned. and they've had to give up £190,000 in rent. So this is one of the reasons why they're having to suspend the dividend payments, because of unforeseen circumstances like that, where students are not actually using the properties, and therefore property partner isn't receiving any rent. Really unforeseen circumstances. If you'd have thought 6 months ago or a year ago, if you're an investor and property partner and you were getting into student accommodation renting, you'd think, wow, this is a pretty safe bet. But obviously, unforeseen circumstances with COVID and students not going back to the university, there you have it. So there are always things that we don't think about that could happen. Property partners also suspended the 5-year anniversary votes, meaning that after 5 years, they put it to vote to the shareholders whether they want to hold on to that property or sell it. So because things are just strange right now in the property market, they've suspended those for the unforeseeable future. And if you are somebody that does like buying shares in property, you can pick up some very good discounted shares now on Property Partner, because they're trading at an average of 18% discount. They also talk about their second charge development loans that they have, which is through Assetz Capital. And I've always been very, very wary of, and particularly second charge development loans. I just tend to stay away from them anyways, because I don't think being in second position is ever worth taking a risk of what you're getting paid for. I think Property Partner pays 10 to 12% on second charge development loans, and they're not even they're not sourcing the loans or the development deals, which can be good and it can be bad. But to get paid 12% returns on a second charge development now, I think is very, very high risk. I wouldn't touch it at that rate. So I don't know what's going to happen, with those second charge development loans, but I wouldn't be surprised if some of them ran into trouble. That we'll have to wait and see about that. Lendy, we had some good news on Lendy this week. One of the development loans, DFL 032, which was based in Southampton, actually was paid back 100% in capital. So that was great news. That was £1.4 million in total repaid capital, and a possibility that they will be paying out the back interest on that too. So a little bit of a bright piece of sunshine in the awful, dismal Lendy situation. So that was nice to hear. Growth Street, we've just had more of the same, lack of information. Gut feeling is they're really trying to figure it out, but I don't think we're going to know anything till maybe next week of what they're deciding to do with that, possibly the week after, but nothing has really changed with Growth Street. Funding Circle share price is in the absolute toilet. It's dropped, I think it was last week was 90p and now 78p. So hopefully you don't own any of those, because those shares are not doing well. And Moneything, I still am wondering where the Ferrari is. So I had purchased a loan a long time ago that was the collateral asset was a Ferrari, and the Ferrari is missing. And I don't think Moneything knows where that Ferrari is. So question of the day is, where is the Ferrari? And why did you not have it secured as an asset? So there you go. Let's talk about negative interest rates. A news story this week in The Guardian is that the UK's DMO, or Debt Management Office, decided to sell for the first time negative interest rate bonds. And those rates, if you were lucky enough to grab one of these negative interest rate bonds, which you probably wouldn't, but you have to watch out that it's not getting put into your pension, because I wouldn't be surprised if these are going into pension funds now. But you would have been lucky to get minus 0.003% on these £3.8 billion worth of gilts that were released into the market. So essentially, they're 3-year gilts, and you will get back less than what you paid for the gilt. So my question is, who is buying those things? I mean, absolute garbage bonds. Negative interest rates. What you're essentially doing is paying you're paying banks to park your money for the relative safety of FSCS protection, and in hand, the banks and building societies are paying the central bank to park money with them, and they're paying a small amount of money to do so. So, you buy a negative interest rate bond, you're getting negative income and negative capital. What a great deal, right? Highly suggest, this is another reason why I've said I think the cryptocurrency is going to be the way of the future. We're seeing it with these negative bonds. Who wants the central government deciding these things? And, basically it's turning out these horrible products that unfortunately some people are going to have in their pensions. But there doesn't seem to be any lack of demand for these negative bonds, because they had bids in excess of £8 billion for these £3.8 billion worth of gilt. So negative interest rates suck. This is really another good reason why, if you do have any money inside of a bank account that don't hold more cash than you need, invest the money for the long term. If you have that time on your side, the interest rate's going to get lower and lower and lower on savings accounts. I think you'll see some of them probably at flat zero soon enough. As I mentioned last week, nationwide, I think Newcastle building societies are all the way down to 0.1%. So, one word of warning too, if you're looking into corporate bonds and you're somebody that likes to buy corporate bonds, be careful, because I think you're going to see some companies that are having really, really big financial troubles. And this week we saw Hertz saying that they were going to be filing for bankruptcy, which is a massive car rental company. Those companies that you can buy corporate bond allocations into are not susceptible and not prone to going out of business. So be very careful with corporate bonds, especially now with what's going on with COVID. I never would have thought that Hertz would go out of business. It's a company that's been around since 1918, and they used to rent Ford Model Ts. I think that was the first car they ever rented. So, if possible for Hertz to go out of business, believe me, it's possible for some other corporate companies that you think would never go out of business. They could go out of business too. So, one question I wanted to answer this week is, I had an email about somebody that had lent money through Unbolted as a limited company, and Unbolted is having a situation now where they're being sued by a borrower, and they're going through court proceedings. And from what the reader said, I have to verify this. I don't know if it's true, but he said that the court has forced Unbolted to give over the names of the lenders, and that includes people that are lending through limited companies. And he said, what advice do I have for investing through a limited company? Well, a couple of things. Anybody can sue you at any time for anything. So if the court decides that they're going to give up the names of the peer-to-peer lenders, it doesn't matter whether you're a inside investing through a limited company or investing as an individual. We saw this with Lendy. They had a situation where one of the borrowers lost their mind and decided that they were going to sue every single peer-to-peer lender that was invested on that borrower's loan, which turned out to be a bunch of nothing, because realistically they're just not going to sue 3,000 or 4,000 lenders. But just be aware that it is possible to be sued for anything at any time. And the best way you can protect yourself lending through a limited company is just not to hold really too many assets in there. If you're sitting on a lot of cash in your limited company, you get sued, then obviously that's a bad thing. So you can just limit your exposure and limit the amount of assets that you hold inside that limited company. That's probably the best way I could tell you as a non-legal advice, but If you are doing it that way, just don't hold too many assets in your limited company. But if you get sued, you get sued. That's I don't think it would ever come to that. I don't think that this borrower is going to individually sue all of the lenders on that loan. I don't think that the court would be okay with that anyways, but it's just something you have to be prepared that could happen. Okay, so I'm going to take a look at your questions, see where you are, see what questions you have. Hi, Paul in Kenilworth, Craig in Ayrshire, John in Nottingham, Sam. What do I think about the new update from Assetz Capital and the new way they are processing withdrawals? Sam, I'll be honest, I have not read that update, so maybe I missed that one. Don't know. Maybe tell me when it came through. And I did notice that they are doing a fourth equity. Maybe that was on the email. I don't know. So they're doing a Cedars fundraise, but I don't know about how they're processing the withdrawals, so I don't have information. Hey, Chica Boy. Matthew says, given so many people trying to exit Ratesetter, it feels like they could become so illiquid that withdrawal orders just grind to a halt. Yeah, I think a lot of people are just trying to partially exit. So, yeah, I'm not so concerned. Most of the people that I've had communication with are just trying to do some kind of a partial exit to hedge themselves. Derek, is the stream about risk? Sorry. So Derek says to me, this is only for new investors, isn't it, Lawrence? I don't know, Derek, what you're asking me. So if you can clarify, I'll answer your question. Craig, there's no real new information on Growth Street this week. I think in the next 2 weeks, you'll probably see more of a significant update, but they just seem to be sending out an email which says, we don't really know anything. So just to keep you in the loop. But I think having an email that doesn't really say a lot is better than no emails, because, lack of communication certainly scares people. But I don't think there's anything particularly interesting that Growth Street has said this week. Sasha says, hi, Lawrence. It's Mike. Hi, Mike. I presume maybe Mike Mason. Have I recently looked at Rebs? I did log into my account to withdraw some money, but I've stayed clear of Rebs for a long time. It's not SME lending through Rebs. It's not been particularly interesting to me. Had some bad experience with them, so I don't know what Rebs is up to. That's the Rebuilding Society too, for anybody that isn't familiar with Rebs. What do I think? What do you think Assetz Capital new round of funding raising for future fund? So I think that kind of on the fence about it, because I always, when I'm thinking about these companies that are taking on debt, I always wonder, how are you going to repay it? And this is one thing that we spoke about last week with Cedars. I know some people are really into this whole idea of Cedars, which is a place where you can take shares, and not strictly shares, but you can invest into startup companies. And I'm personally not a fan of that. I don't ever see a way of getting your money out. There's no liquidity. The company would have to buy you out, or either be sold for you to get paid back. So I was wondering, how are these companies going to pay back debt? So yeah, the future fund is this newly announced government where they're going to co-invest in growth companies. I mean, look, whenever you can get government money, take it, right? If it depends whether it's a loan or whether it's just kind of here, we'll give you money, you don't have to pay it back. Well, great. I'm not a huge fan of the government, so I'll say take anything you can. from the government and, use that money. So I can't blame them for doing that. And Assetz is a approved lender for CBILS government loans. So obviously they have some favor with the government regarding that. So I don't see it. So let me see. The funding is on a matched funding basis as a convertible loan alongside our other investors. Okay, so there we go. It's not a grant, it's a loan. How are you going to pay it back? That's the big question. Assetz Capital has been profitable in the past. I don't know. I'll have to look at their accounts. It's actually on my list of things to do because I know they released accounts. But let me write that down. Yeah, I just wonder, how do you pay the debt back? So the same thing that's happening with COVID. All these companies that are taking out billions of dollars of loans. How do you pay it back? It's got to be paid back somehow. Maybe the interest rate is negative. Maybe the government's offering Assetz Capital a negative interest rate loan where they actually pay assets to borrow money. That would be a pretty cool thing. So Bordell says, stick your money in the stock market. Yeah, that's a very broad statement. Interesting topic, though. The markets are, what are we at today? The markets are, let's see, FTSE down. Let me refresh. What? FTSE's down about 0.6. S&P down 0.4. Dow down barely anything. Yeah, the markets are just surging. Very disconnected. I mean, stock traders look for the future, don't they, when it comes to stock market, predictions. They're looking 6 months to a year out. What do I think? I don't know. I think that the market's disconnected. I think that I wouldn't be surprised to see a big drop again, but like Jack Bogle said, nobody knows nothing. I've been sitting in cash. On a portion of my account is in cash just for, I wanted to do this experiment on timing, trying to time the market just so I could give the information on the website on financialthing.com. And for the most part, I've gotten the timing completely wrong. I sold out I think the Dow was at 22,000 when I sold out, and now it's at 26,000. So the right play, I think, would have been to buy in when the Dow was at 18,000. But again, when the Dow was 18, I was thinking the Dow's got more room to fall because looking at the economy, I'm going to look right now, we've got the UK is not so bad with their unemployment. It's about 3.6% at the moment, but the US is now approaching 20.5% unemployment, which is insane. And yet the Dow is as high, the highest it's been since the drop from the corona fallout. It doesn't really make any sense. But yeah, the move would have been to time in at 18,000. Problem with market timing is you don't know when the bottom is. And emotionally, I was thinking, just hang on, wait for more. I think it's going to go to 15, 14. And I had other people telling me, no, there's going to be a high of, you're going to see a high of 30,000 by the end of 2020. So who knows what to believe. I certainly didn't get the timing right, but the only thing I got right was the Shell shares that I sold when they were 2,500 and now they're at 1,400. So that's just pure dumb luck. I didn't know, that was before the coronavirus hit and the massive oil downturn. So yeah, timing is very difficult, but I do, for a long-term investment, I do like the stock market. I like the index funds as always. Me too said, how do you make a small fortune in stocks? Here's what you do. Here's how you make a small fortune. I, as a joke, bought, I'll show you this. You might not be able to see it on the screen. Let's see if you can. No, you can't see it, but I bought Norwegian Cruise Lines when just a few shares when it was $11.60, and now it's 1961. So it's up 69%. So how you make a small fortune in stocks is you take massive risks, dump all of your life savings into a stock that you think is going to make a massive jump. Like, who would have thought Norwegian Cruise Lines would go 69% up in a period of a couple of weeks? That's how you make a small fortune. You can also lose a small fortune. So there is the absolute downside. Personally, I'm more of a invest for the long term, and anything that I do like that is more just for testing, to be able to write about what timing and investing in individual stocks. I don't love doing it. I stopped doing it a long time ago. So Craig says, why is there such a disconnect between the stock market and what's actually going on in the economic world? Two reasons are, stock traders are looking for the future. They're trying to predict what the economic recovery would be like in 6 months or a year. The second reason is there's just nowhere else to invest money. People with retirement accounts are still going to continue to put in their allocations every month. In the UK, obviously, you've got your large ISA allowance. You don't really want to be putting in ISA cash or bonds. Now we're seeing negative interest rates. So, Tina, there is no alternative. There's just nowhere else to put money. You will cite a peer-to-peer lending if you are lucky enough to own rental houses. Yes, you can do that. But for the most part, most people don't have that type of ability to buy buy-to-lets, especially debt-free. So, that's why there is such a disconnect right now, and the stock markets just don't reflect what's going on in the economy. Hence, Norwegian Cruise Lines. I mean, they haven't been cruising for several months now, and the stock's up 69% because they have access to a lot of cash that's going to float them through these difficult times, and stock traders are trying to plan forward what they think is going to happen with these cruise stocks. And maybe in 2 years, the cruise stocks will be completely recovered. Certainly not a risk I would want to take. So Mike said the Ferrari isn't missing. Mike, I thought that when I'd read the update on that loan and it said they weren't sure where the Ferrari was. So maybe I'm mistaken about that. But I looked last week and there hadn't been an update on that Moneything loan since January. And it just said, well, we're questioning people trying to find out where the Ferrari is. But maybe I'm wrong. So Bordel's giving some stock tips. Yeah. Tesla, huh? Yeah, I wonder, are they going to sell a Cybertruck in England? That would be interesting, trying to get that truck down very tiny little roads. Matthew says, what are my thoughts on the FIRE movement? Yeah, so FIRE, what FIRE is financially independent, retire early. So basically, a lot of people within the FIRE movement believe, live way, way below your means and stash away as much cash as you can, invest as much as you can, retire early. I think it's a great principle. I used to think that being completely minimalistic was the way to be. But I got to the point where I was being so frugal that I just wasn't enjoying life. And I didn't want to go on a holiday, or I didn't want to buy a new pair of shoes because I was trying to store as much cash as I could for retirement. What I found was that one day I just woke up and said, wow, I can't, go through my entire life like that, because I wasn't going to be able to retire at a very, very young age anyways. And, my thought was, I watched my dad retire at 65, and then he was diagnosed with cancer the year he retired. And my thought was, I think you do have to enjoy life somewhat, right? And so being too frugal to hit this FIRE, financially independent, retire early goal, very quickly you do sacrifice some pleasures in life that, personally, I don't want to sacrifice, but I think, anybody that wants to do it, it's great. If you can retire at 35 or 40 years old, then go do everything you'd like to do in the world. That's beautiful. So yeah, FIRE, I think, is a good system, but I don't think that you should be completely frugal. That also goes along with the topic of spending, like people that just hoard onto their wealth and they don't want to spend anything. And what are they really doing? Are they going to die with a lot of wealth and then pass it along to their children? Sure, that's fine. There's nothing wrong with that. But I think that there's nothing wrong with spending what you make, if you can afford to do so, and not trying to hang on to everything and squirrel it away until you're old. So I don't necessarily think that personally, I don't have any children. If I did have kids, I don't know that for me as a parent, I feel necessarily obligated to leave everything that I had to my kids and to just save up this massive amount of money to be able to leave to them, because kids have their own obligations in life to be able to make a living and fend for themselves. I definitely would leave something to them and maybe give them a start on a house or a car or something like that. But, I definitely wouldn't be thinking about just save my entire life just to die and leave it to other people. I think you have to enjoy life. There's a lot of cool things to see out there in the world. And I'm not a frivolous spender. I don't take debt. If I buy a car for cash, if I can't afford to buy it for cash, I don't buy it. Definitely taken car loans in the past, won't do it again. So I'm not a frivolous spender. I don't go out and spend money on clothes every week. I don't go to restaurants all the time, but I also think, I like to travel and go see the world, and who knows what happens tomorrow, right? We could all kick the bucket. So I think you do have to go out and enjoy life somewhat. So yeah, please hit that thumbs up button. There's 36 people on the stream. We got 23 thumbs up, which is very, very kind of you. The other 13 people, if you don't like it, tell me why, or give me a thumbs up. Show me that you like the stream. Helps me with the YouTube algorithm. I very much appreciate you all for being here. Let's see. Yeah, I agree, Baldell. Hacky Chap says, notice there is more loans via Ratesetter in the last 3 months, or for property rather than consumers. Interesting or inevitable. Yeah, I think that Ratesetter originally had, when I went to visit them, their portfolio was about 20% of property loans, but I think they're going to take what they can that makes sense. They're not frivolous lenders, but if they get property deals that make sense to them, then yeah, I think they're going to take them. So I would say probably inevitable, not so much interesting. Craig said, FIRE is not easy unless your wife and kids are also on board. Yeah, getting a wife on board with FIRE can be very difficult, especially if they're into buying purses and shoes. Not to be sexist or anything, just saying. Mr. Mason says, REBS now allows you to buy loans with guaranteed capital repayment over 3 years, averaging 18% net returns, but will be low with the guaranteed payback. I mean, I'm kind of shocked. How do you do that? How do you offer a guarantee paid back? And sure, it's great if the company survives, right? If REBS goes down, Rebuilding Society fails, then that payback guarantee doesn't mean anything. But I'll definitely look into that. Let me write that on my list. It sounds risky. I mean, 18%. What are they charging the borrower? Is it if you're getting paid 18%? Okay, so maybe what would the guarantee? 12, 13, I don't know. But what is REBS charging the borrowers? What's the spread? I don't know if Rebuilding Society publishes that. That's a lot of the times some of the peer-to-peer companies don't actually tell you what they're charging borrowers. So it's very hard to figure out what your risk level is. This is another plus thing about Loanpd. By the way, if you invest through Loanpd, you can see what the borrower is paying on each loan. Usually it's about between 7 and 7.5%. So loan, there is a spread there, but it's not huge. ES, hi ES, how are you today? ES says Crowdproperty, you don't even need to post the transfer form to them. It's all email now, makes life easier. Transfer form. That's interesting. It's nice when things are easy. John Day says markets supported only by government funding and low interest rates. Yeah, John, that's very much true. So I have a friend that's a trader. He worked for the Commonwealth Bank of Australia, CBA, and HSBC. He was with Lehman Brothers, and he told me that he believes that the stock market is going to hit an all-time high this year purely because the governments are pumping so much money into the economies that will completely support growth. Yeah, I think you're right. I think that's one of the reasons the markets are doing well. And plus, yeah, when interest rates are absolutely low, people go into equities, right, into stocks and shares because there's nowhere else to put money. This is another reason why I've kind of been talking about Bitcoin a little bit more over the last couple of weeks. And I think that the UK offering negative interest rate bonds is just another perfect example why it's not such a bad move to hold some crypto, because the governments are just absolutely destroying and devaluing currency, when they're doing things like printing money, offering negative rate bonds. I'm not a fan, but money printing has really gotten out of control. I don't know how this money gets paid back. Derek says the fan GANs can't go up forever, must flat top the 500, look for value elsewhere like Lawrence's and CLH. Yeah, like I said, I'm not a big fan of trying to pick individual stocks and shares. I think, imagine if you'd have picked individual stocks in, say, February of 2020, and then, I've read countless investment forum posts from people that said they got scared, they'd bought in January or February, watched their stocks go up a little bit, and then saw this huge plummet, and they made emotional selling decisions, like I actually did too with when I was testing the market timing. I probably sold out a little bit more than I wanted to based on emotions. I think that's the problem when you buy individual stocks. If you have a portfolio of, say, 10 stocks and you see 5 of them at negative 20%, do you have the ability to hold on through the rough times? And I think countless people sold out in March when the stocks were starting to really take a beating. It's the same with Bitcoin. If you were able to buy Bitcoin when it was 33 cents back when 2011, would you have had the stomach to ride it up to $20,000? You probably wouldn't. You might have sold out of $500 or $1,000. So there's a lot of emotion that comes along with trying to pick out individual stocks and shares, and it's what people, market timing and emotional investing decisions really kind of gets people into trouble. That's why I like the index trackers. Just buy one thing. Don't worry about it. And then also, if you have a lot of time to do research into individual stocks and shares, you probably have a better shot at trying to pick out, the right ones. But yeah. Mary says, why aren't tens of thousands of people watching my videos? Mary, I asked the same thing. I have no idea. I don't know. But all I care about is the 35 people that are watching tonight. I don't care about the other tens of thousands that are not here, because you are the most important people. Thank you, Chica Boy, for the thumbs up. John says, yes, any joy of getting peer-to-peer CEOs to come along? Yes, I am having some joy in that respect. What I'm not having joy on is the technical of how to do it, because I have to make some changes to my very old Macintosh computer that cost an arm and a leg is now worth probably the price of a book stand. But I have to do some technical tweaking to it to get the ability to have somebody else come onto the stream. But give me a couple of weeks and I will have somebody very special on the stream with me. Bordell says, I have money in lending works waiting for loans to be sold. Yeah, they're still on a freeze. Aki Chat, what do I think about buying property in Spain? Depends where you buy. I have a friend's mother that owns a property, or owned a property in Spain, and she had been living over there for a while, and she couldn't sell it. It took her 8 years to get rid of it. So depends what you want to do with it. If you're using it for a rental or as a to live in, yeah, sure, why not? But I think the prices are going to be absolutely a steal over there, because who's going to want to buy property in Spain right now? So you could probably pick up some great deals. One thing I've noticed in England is I've actually been looking for a rental property, a buy-to-let. And for one, there's not really anything for sale. And two, I've seen absolutely zero price reduction. Now I'm looking in a specific area of the South, so it may just be, that area, but I've seen zero reductions in prices. But there's absolutely a lack of supply. So I think maybe when the COVID clears and people start to put their properties on the market, there may be a glut of properties for sale. So you may see prices start to fall. Thank you, Chica Boy. Yes, he's saying, please give a thumbs up if you can. Let's see. Mr. Mason says, in rebuilding society, the guarantor is the previous owner of the loan, who can only receive the capital back once the loan is successfully completed. You pay a premium for these microloans. Yeah. The owner of Rebuilding Society he's probably watching. I don't know if you're watching, but he's been trying to get me to reinvest through Rebuilding Society for a while, and I've just been really reluctant. I don't know. There's just something about Rebuilding Society that I just had some bad experience with I think 3 or 4 of the loans through them. And, once you get that bad taste in your mouth about investing, maybe they've changed. Maybe they've cleaned things up there. It seems like they're doing Brismo now, which is, Brismo is one of I think it used to be alt-fi data. So they're giving their financial information, loan information to Brismo, which is a really good move. But, I'll tell you what, I'm going to look into Rebuilding Society over the next week and see what they're up to. But it just seems very risky. I don't know. Just those high interest rate lending. They have a 3.7 out of 5 on Trustpilot. So I do tend to look at those Trustpilots. I don't know Let's see. So Rebuilding Society's 1 star. They have 19% 1-star reviews. Around half of my loans defaulted, and I will lose around £1,500. That's one reviewer. Another guy says not worth the risk. The overall platform default rate is in the region of 12%. Slow website. No chance of recovery if loans default. Poor due diligence. Yeah. And who knows if those reviews are legit? Some other company could have put those up there, but it's not looking good. I mean, it's kind of what I've always thought was, I remember one of the loans that I had put it wasn't a huge amount, but it was a good part of my portfolio in, and they just didn't recover any of that. And I think I got 5% back, 10%. So it's very hard to get recoveries on business loans when there's no property backing the loan. A lot of those rebuilding societies don't have any real assets to secure. So a lot of it is on debentures and then personal guarantees, which if a company goes under, personal guarantees are pretty much worthless most of the time. Hey, Hugh, nice to see you on the stream. The BSs are struggling right now, shedding staff. Let's see. Plenty of bargains in Spain, yep. Yeah, I think you'll see the property market probably take some hits on the prices in the next couple of months, but not so far. At least outside of London. I know London's gotten hit pretty hard, and London property prices were starting to decline before COVID. Yeah, Mr. Mason, I didn't think that you were on commission with them, but yeah, I mean, I guess you could use Rebuilding Society as part of a diversified portfolio. If you didn't put too much of your money in, you were investing through other peer-to-peer companies, maybe you can cash in on some of those super high interest rate loans, but risk. Crazy Cash Pap. That's a great name. I like that. How safe is money invested in Vanguard? I think your money invested in Vanguard is, the chances of it going to zero are next to nothing. If let's say you were invested in, say, a US fund through Vanguard, the only way I could ever see that fund going to zero is if China invaded America and took everything. Then your fund would probably be worthless. But other than that, chances of it going to zero, not, at least on an index tracker, is practically 0% chance. So I would say it's safe in that respect. Now, volatility-wise, you're going to have the ups and downs of the stock market. So if you're saying how safe is your capital at, maintaining its level, obviously that depends on what the market's doing. If market drops 30%, your index tracker goes down 30%. So safety, not necessarily safe, but Vanguard as a company, I would admit, is absolutely very safe, ultra safe company, just as safe as Fidelity. Crowdster, no, I've never. Wardell, I've never looked at Crowdster. Let me see if I can pull it up. Crowdster, social. What is Crowdster? Fundraising for a better world. So, Christian missionaries have been fundraising their own 501c3. Yeah, that's interesting. I don't know. I'd have to look more into it. Never heard of it before. I do like companies that are doing, lending to good causes. I forget what was the name of the company that. Kiva was one of the companies that started out, lending money to developing nations and people that needed help to start businesses overseas. So yeah, I like that. But let's see. We've been streaming for an hour and 5 minutes. We're probably going to wrap it up. See if there's anything else on my list. Again, don't forget to join the Facebook group, and then the stream on Saturday. We're going to do a stream at 7:30 on Saturday night about risk assessment. I'll give you the link here if you want to bookmark that link. So we'll look at how to assess risk on peer-to-peer lending companies themselves, and also the peer-to-peer lending loans, what kind of things you can look out for, how you can protect yourself as best you can. So let's see if there's anything else on my list. There's no news this week on funding securities administration process, and Octopus Choice is still stuck in purgatory. No change there. One other thing too, I actually have 5 emails this week asking about the same question about financial advisors. And so if you know anything about me, you know I'm not a huge fan of financial advisors, because just experiences that I've had with dealing with family financial advisors who used to do things for my mother and my father. When my father passed, I started going through his statements. He had an account with Charles Stanley, and what I noticed they were doing was frequently trading his portfolio, and then they had double charged him. And of course, he never paid attention to it because he was just not really interested in looking at what was going on, bless his soul. He just gave his advisor his money at Charles Stanley and, trusted them to do the right thing. He had been overcharged by thousands of pounds in trading fees. So what I went to Charles Stanley and I presented them with the information and said, look, you've been double charging for a good amount of months here, and, here's the information. And they challenged me on it for a while and then eventually paid back those trading fees. The advisor over there was very adamant that I had made the mistake. And, I don't like the fact that they were very aggressive towards me. And I'm not a victim. I'm not the victim type. I'm like, okay, whatever. It happens. No problem. This is just the facts. I present them with the facts. And the thing is, though, if I hadn't have gone through those statements, we would never have known, and we certainly wouldn't have gotten that money back. What's worse was the returns on the portfolio of the Charles Stanley account weren't really that good. They were about 5%. And when I talked to the advisor about it and said, look, 5%, I think they were on a 5 out of 7 risk scale on the portfolio, and I just thought it was really poor on the return. So then I moved the money to another financial advisor called Blue Sky in Dorset, and they managed to return about 2% over 2 years, or maybe 2% a year. And what I realized is they're just sucking so much money out of the fees. What they do, a lot of financial companies and advisors, is they'll take your money and invest it into a third-party company that has a bucket of shares and a bucket of unit trusts. So Blue Sky, for instance, had invested my family's money and my mother's money into 10 different unit trusts, and the returns were, one unit trust was fine. I think they put some into the Neil Woodford Fund, and the other one that's very popular too. And one of them had done really well, and one had done really badly, and it just really leveled the results leveled each other. And I had looked at the amount of fees they were charging. They had charged 2% up front for the entire portfolio, and then they were charging originally they were trying to get 1.75% a year for a management fee, and I talked them down to 1%. And just the fees from the funds that they were investing the money in were very high, compared to like a tracker that has a 1% fee. Some of the funds that they had invested the money in were 1%, 1.5%. One of them was even 2%. And when you added the 2% fee in with the 1% advisor's fee, you're talking about a 3% a year fee. Well, now if your portfolio is earning 5% and they're taking 3% out in fees, now you're down to 2%. Makes perfect sense why the Blue Sky portfolio was just performing terribly. So, this is one of the reasons why I'm just so kind of against financial advisors. I think, yes, maybe you need one for tax reasons to help you plan your tax situation out. But if you run some simple numbers, I ran a little compound calculation the other day on a £50,000 investment that you put £500 a month in for 20 years. If you get a 5% return over those 20 years, you are going to get in the region of £342,000 in returns. That will be your total portfolio. So that's at 5%. Now, if you're doing that through your advisor, you'd probably be getting about 5%. If you do it on your own, you get that 2% back in returns over those 20 years. Now you're going to get $463,000 in returns over those 20 years. So that 2% has actually cost you close to $122,000 in fees. I mean, that's a huge amount on a £50,000 portfolio. And some of the people that emailed me this week said, I don't understand, how a 1% fee can just be so costly to me over a long period of time. And I explained these numbers to them, and it looks so crazy when you look at it. That's on 50 grand. So a 50 grand portfolio to 2% loss on returns is costing you 121,000, right? Do a £100,000 portfolio, the same thing, £500 a month invested over 20 years. Now you're looking at the difference between 7% return of 665,000 versus a 5% return of 477,000. So on a £100,000 portfolio, you're talking about it's cost you and loss of compound interest and fees, 188 grand. So if you think your financial advisor is worth 188,000 over 20 years, go for it. I personally wouldn't do it. I mean, I don't want to pay a financial advisor 188 grand to put me in a bunch of high fee, paying situations and maybe a portfolio that doesn't do well. But rant over about financial advisors. I just think you can DIY invest. Most people just don't need to invest through financial advisors. They can do it on their own, and it doesn't take much to become a financial advisor, by the way. It doesn't take a lot of training. So you might be in a situation where somebody who's investing your money has very little experience. And then also they may be investing you in things that they're getting kickbacks on financially or that pay the better commissions. If you do go to a financial advisor, go to one who has the fiduciary responsibility of doing what's best for you, and then maybe that's fee-based and not on a continuous percentage basis. So, rant over. Mr. Mason says, do I have any views on Able Rate? Yeah, I like David. What I don't like is these high interest rate. I've gotten burned so badly on high interest rate advertised loans that I just don't have the stomach for the risk anymore. But I do like the fact that David posts regularly on YouTube about the state of the portfolio. He's very transparent. I have a little bit of money in Able Rate, but I would use it as part of a diversified portfolio. Personally, wouldn't put too much into it. Yes, David, nice to see you. Have a great night. Yes, Sam, that's true. Okay, so I'm going to wrap it up. I think we've covered everything tonight. Hope you enjoyed the stream. Again, hit the subscribe button and hit the thumbs up. Again, see you on Saturday if you want to come join us on the stream on Saturday evening. Talk about risk and anything else you want to chat about. And thank you again. I really enjoyed being here with you and giving you as much information and value as I can. Matthew, if you want to send me an email, I'll be happy to tell you more about how I monetize financial thing. If you want to send me an email, I'll put it in the chat. And there you go. All right, everybody, be safe out there. Be well. Enjoy yourself, enjoy your life, and be healthy. Speak to you soon.